The unemployment rate dropped sharply to 4.6%, and 178,000 new jobs were created as the economy settled into a virtuous cycle in November. A virtuous cycle is the exact opposite of the vicious cycle that caused the Great Recession of 2008, when the housing bubble of 2006 begat the debt crisis of 2007. Now, a chain of good economic news is triggering more good news. The sharp drop in the unemployment rate in November from 4.9% to 4.6% is close to the low in unemployment last seen a decade ago, and that was at the peak of the last economic boom. Newly released data shows that business investment, one of four components of U.S. gross domestic product, shot up last quarter. For the first time in 5 quarters, business investment contributed to GDP growth. An inventory correction is behind us now, and businesses, at long last, replenished inventories. But the really good news in this group of charts is over here. Consumer spending, which accounts for 70% of U.S. economic growth and is by far the most important of the 4 components of GDP growth, is poised to drive strong growth in the months ahead. The new GDP data reflects all the good news. The black bars show the growth rate of the U.S. economy quarter by quarter for the last 20 years, through the third quarter of 2016. The red bars show the consensus forecast of about 70 economists interviewed in early November by the Wall Street Journal. The final growth rate of 3.2%, just reported by the government, is a big revision and was bigger than expected. And 2.3% through the third quarter of 2017 is a good expected rate of growth. How long can the Fed keep the virtuous cycle in equilibrium? Fed Chair Janet Yellen has signaled for months her intention to tap the brakes on the economy by raising rates a quarter point in December, and the strong jobs number reported on Friday makes it more likely the much-anticipated rate hike will indeed happen by the end of 2016. However, given the low inflation figure, Ms. Yellen can afford to let the economy ride at the pace it's been at for longer, and another rate hike could be many months off, which is good news. On the week that all this good economic news was released, the Standard & Poor's 500 stock index fell 1%, hinting at the folly of short-term price movements. Trading at 18 times the 12-month earnings, the price of a share at America's 500 largest publicly owned companies is in line with the historical norm. The bull market is old by historical standards, and a drop in stock prices could come at any time in the event of a sudden change of sentiment or unexpected bad news. But the economy is growing, and key economic benchmarks are not exhibiting any signs normally preceding a recession. With all this concern recently about fake news, we are committed to always being a trusted source for breaking news and analysis about economic and financial events. Our reports are based on economic fundamentals and authoritative data sources through difficult periods as well as the good times. Please feel free to share our timely weekly research with your family and friends.